So this is question 1 of paper 1. So for this question, we will first have to break down the information that's given to us. In this case over here, we have the opening entry. This is last year's closing date, right? Which means that all these are the opening amounts for this year, 1st Jan 2018. Okay, and over here, these are the payments and receipts by check, so you know all this will hit your cash at bank account. And then you have the information that is required for at the end of the year. So the first thing you're supposed to do is prepare the insurance account. So if you look first for the opening entry, you have accrued insurance from last year. You have to transfer this $300 to the insurance expense account. So accrued insurance is credit in nature. If you want to take it out, to transfer it out, you have to debit your accrued insurance and then credit your insurance expense account. Okay, so you have to transfer out this $300 from the accrued insurance expense first. So this is a $300 credit. During the year, you make payments. You make 2 payments on February 18 and 7. You cannot combine them because they are of different dates. So what you do is when you make a payment for insurance, your expense will go up. So debit your insurance expense, credit your cash at bank, once on February 18 and the other one on August the 7th. Okay, now you're done with the opening entry, you're done with the cash at bank. Now you look at the information required here at the end of the year. So for the year ended, the annual insurance is $500. If you look at your account, $700 is recorded. So more is recorded than what it should be, right? So therefore, you know that you need to take this $200 out of here. Okay, so if more is recorded, that means this is what we call a prepaid insurance. Right, so you need to transfer $200 out of here into the prepaid insurance account. And therefore, with the remaining $500, you will transfer it to the profit and loss. So this is for part A. For part B, you are now supposed to prepare the commission income receivable account. Remember, this is a receivable account, so this is an asset. It is not an income account. So the first thing you have to do is to look if there is any opening entry. Okay, so we're going back to our question again. You have a commission income receivable from last year. All right, so what you need to do is have a balance brought down of $754 debit. So first thing you do on the first day is to transfer this 754 out of here. So how to take it out? This is a debit. When you want to take it out of here, you will have to credit it and transfer it over to the commission income account. And now there is nothing left inside your commission income receivable account. Right? Now the next thing that a lot of you are confused is that you will record this commission received inside the commission income receivable account, which is wrong. When you receive commission income, you will debit your cash at bank and you will credit your commission income account. Can you see that it doesn't hit the commission income receivable account at all? So you will never record all these inside your commission income receivable account. Okay, so you don't have to record any of this here. Now, if you look at the information over here, it says that commission income receivable was $386. So what happens is when you receive commission income, okay, like I said, you will debit cash at bank and then you will credit your commission income account, right? But in this case, it is receivable, which means you have earned this, but you have not received the $386. So if you have not received this $386, you cannot debit your cash at bank. Instead, you will make an adjusting entry whereby the $386 will go inside an account called commission income receivable account. Okay, so for the year ended, you have to adjust this entry, debit your commission income receivable account, and then you will do a balance brought down to the next financial year. Right, for part C, you are supposed to state the effect on income and expenses if no adjustments were made for the commission income. So if you did not adjust the $386, right? If you did not record the $386, then your income would be understated, right? And if you did not take out this $200 from your insurance expense account, then your expenses will be overstated by $200. Okay, and finally for part D, you're supposed to state and explain the accounting concept when we are adjusting for prepayments and accruals at the end of the accounting period. So here are the two concepts. One is the accrual concept. In this case, income earned, expenses incurred during the accounting period are recorded, right, regardless of whether cash has been received or paid. And of course, the matching concept, where we match the income earned in the same period with the expenses incurred to calculate profit for that period.